Does dollar cost averaging (DCA) actually work? Dollar cost averaging is basically investing money in an asset at regular intervals like every Friday or every month or whatever interval you choose. The opposite of dollar cost averaging is just putting in the entire lump sum at once in that asset. Dollar cost averaging is what most people do when investing in the stock market. Usually, someone would put a portion of their paycheck, which comes every 2 weeks, into the stock market. That 2-week interval where they invest their money is dollar cost averaging. But what if you had a lump sum today, like $100,000? Should you dollar cost average that or invest it all at one time? Of course, if you don't have a large sum of money, dollar cost averaging will likely be your only option. There's two goals here: maximize returns and reducing risk. Dollar cost averaging reduces risk by spreading out your buying, but reduces your maximum gain because you'll always have some cash not invested. Going all in at once can maximize gain, but buying it at the wrong time can really hurt your investment. Let's turn the clock back to January 2022 and compare dollar cost averaging and lump sum investing in the S&P 500. For argument's sake, let's also say you have $100,000 to invest and you're deciding to spread out your buying or lump sum it. At the beginning of the year, the S&P 500 Index ETF SPY was at $477.71 per share. If you invest all $100,000 at that price at the beginning of the year, you'd own 209 shares plus $158 in cash. But what if you dollar cost average and decide upon a weekly interval? That's 31 weeks so far in 2022 when I'm making this video. As much as possible, you want to invest an equal amount each week, which comes out to $3,225 every week. If you dollar cost average like that, you'd own 224 shares worth $94,000 plus $5,800 in cash, with an average SPA price of $420.37. Compare that with going all in at the beginning of the year and your account would be worth $87,000 plus $158 in cash. In this example, if you dollar cost average, you'd have $98,000 with a 1.87% loss. If you went all in, you'd have $88,000 with an 11.98% loss. So as you can see, during a down period, dollar cost averaging can help you protect your investment. But that's a down year. Most years aren't like that. Since the SPY started trading in 1993, there have only been 6 down years, including this year so far. Let's look at another year, 2021. We can do the whole $100,000 dollar cost averaging versus lump sum just like we did for 2022. If we did the lump sum, we'd buy SPY at $381 per share, giving us 262 shares plus $109 in cash left over. For dollar cost averaging, we'd again buy in every week, splitting the $100,000 into 52 weeks, $1,923. For the lump sum, 2021 was a good year with SPY closing at $474.96 per share. With our 262 shares, that gives us $124,000 plus $109 in cash, a 24.54% return. So yes, 2021 was an up year for the stock market. So what did dollar cost averaging do during the 2021 up year? If you bought every week, you'd own 215 shares at an average price of $422.19 per share. You'd end 2021 with $102,000 of SPY and $9,200 in cash, which equals $111,000. In 2021, if you did a lump sum, your return would be 24.54%. If you dollar cost average, your return would be 11.34%. Just as expected, lump sum will do better than dollar cost averaging in an up year, while dollar cost averaging will protect you during a down year. So then it all comes down to who you are as an investor. What is your goal here? Dollar cost averaging will help reduce your loss during bad times, but lump sum will maximize your gains during the good. Also know that the market has been up more times than has been down. That should be a consideration. Do you want to grow your wealth or do you want to protect it? There's no wrong answer, there's just different goals. And it's best you know the possible outcomes of each before investing. So what are your thoughts? Do you go lump sum or do you dollar cost average? Comment below. And as always, take care of your money.